All right, let's get started. My name is Scott Nyquist, and I'm going to be the moderator for this event. And we really have a fantastic panel here this morning with three leading thinkers from the venture investment community, each with a lot of insight to share with us. So I think our plan is we're going to ask each panelist to give a short description of their firm and what they do and where they're spending their time, and then we'll get into a discussion about investment and innovation. Christina, could we ask you to start?
Excellent. Hi, Scott. Good morning, everyone. I'm very, very excited to be here. Thank you to ARPA-E for hosting this amazing conference. I'm Christina Karapataki. I'm a partner with Breakthrough Energy Ventures, and our mission at BEV is to launch, invest, and scale climate companies that can significantly reduce greenhouse gas emissions and also build massive company opportunities. We've been around for 7 years. We've deployed and committed over $2 billion at this point in over 110 companies, and many of our companies have significantly benefited from working with ARPA-E and accelerating their technology. We invest early. We like to invest in seeds and Series A. We're comfortable taking the technology risk and partnering with the entrepreneur from the very beginning across all sections of climate, transportation, manufacturing, buildings, food and ag, and electricity. And just a little anecdote, my first ARPA-E conference was 12 years ago. At the point I was working in corporate venture capital. I know there are a lot of corporate partners here working closely with companies. I moved on to work more closely with the entrepreneurs and company building, and excited to see how much this crowd has grown since the first time I was here. And I wanted to also say, like, we're feeling the urgency at BV about getting these companies to scale. And we're very excited to see over the last 15 years that ARPA-E has been doing it, and the 7 years that we have been active, how a lot of new climate solutions that were not even considered 10 years ago have now done successful pilots and are talking about first of a kind and scale up. So excited about the conversation, and thank you for having me.
Shayle, you want to go next?
Sure. Thanks for having me. Pleasure to be here. I mean that genuinely, by the way, which is saying something because I hate conferences, but this one is sort of an exception for me, so I'm happy to be here. So Energy Impact Partners, my firm, we're about 9 years old, and we're a multi-stage investment firm. So we partner with companies, everything from their first investment they receive all the way up through their ultimate successful public offering or whatever the final end state might be. And we're entirely focused on the energy transition and decarbonization across the platform. The thing that makes us kind of unique is that the majority of our capital base, we have about $4 billion under management, majority of that capital comes from a coalition of large strategic investors. So this is big corporates. There's over 80 of them now, and they span a variety of different shapes and sizes and types, many in the energy industry or heavy industry and manufacturing, transportation, mobility, all the sectors that are heavy emitting sectors. And part of our thesis on the world is that we can leverage the relationships that we build with all of these investors in our funds, both to take advantage of their subject matter expertise inside these organizations. Is just an enormous wealth of knowledge that we need to bring to bear as we're trying to understand what new technologies will work and won't work and the challenges that they'll face along the way. But equally importantly, trying to build a bridge between the innovators in whom we are investing and these big strategics who tend to dominate the industries in which the innovators are trying to play. And so we do a lot of work to try to bring these two groups together. And that can, take the form of direct business relationships and bookings or partnerships or knowledge sharing, whatever it might be, but we do a lot there. And as I said, we have sort of multiple parts of the platform. Where I focus is what we call our Frontier Fund, and the Frontier Fund is basically a three-part mandate: early stage, deep tech, climate. So the way that we think about it in the Frontier Fund, and this is also generally broadly true of EIP, is that we're in some phase, I would say probably the early phase of this multi-decade transformation to get from where we are today, which is realm of 50 gigatons of CO2 emissions, CO2 equivalent emissions per year, down to net zero, maybe net negative by the time we get there. So we have 50 billion tons, maybe 60 billion tons a year of CO2 equivalent that we have to stop emitting and sometimes remove from the atmosphere over a pretty short period of time. We're in the mid-2020s now, and we got to do this by 2050, if not earlier. So if indeed we're going to do that, and realistically, if indeed we're going to get anywhere close to that, then we have to execute some pretty fundamental transformations to a bunch of large industries, the exact ones that Christina mentioned, right? Energy, transportation, and mobility, food and ag, manufacturing and industry, and buildings and real estate, and then we have to build an entirely new industry around carbon management. And each one of those things contains within it multitudes of multi-billion-dollar, often $100 billion, maybe trillion-dollar opportunities. And so we're focused on taking big swings at big problems in climate, but with a pretty clear-eyed view as to what that takes. There's a road behind us that is littered with failures of companies that have tried to build something really big and hard in all of these industries, which tend to be large and legacy and incumbent-driven and often very highly regulated. So we try to bring all those lessons to bear, along with all this expertise that we've built up internally and that is housed within all of our partners, and try to use that to catalyze the success of companies that are innovating on a truly revolutionary technology that will make a difference, a dent in that overall emissions picture in the long term.
Yaniv?
Nice, thanks. Pleasure to join you all, and thanks to my colleagues here, and also to Dr. Evelyn Wang and all the folks at DOE for putting this event together. Super excited to spend the next couple of days learning more and meeting some of you. A little bit about Angeleno Group. So we've been around for over 20 years, so probably one of the oldest and largest players in investing in clean energy, climate solutions, kind of broadly across the whole spectrum. We have about $1 billion in capital under management. We're investing out of our fourth fund, and our investments tend to be a combination of late-stage venture, companies that have revenues, have a product that you could touch, some margins you could get a sense of. They're probably still consuming capital. They might not be profitable. That's about 20% of the portfolio. And the vast majority of the portfolio is growth stage, growth equity, where we will look at family businesses, corporate divestitures, high growth companies, and then companies that graduate from the amazing work that Christina and Shayle and others do in the earlier stage, where companies are sort of at the scale phase. So we've led or co-led almost $3 billion of financings through our history. We've driven about $9 billion of enterprise value, and cumulatively almost $20 billion in revenues. That all sounds like there's been an extraordinary amount of progress. You're all sort of the next phase of that progress, but it happens in small, strategic, smart investments that happen in great companies at the right moment. So we tend to be with companies when there's commercialization problems to solve, cost downs to solve, partnerships, go to market, and we tend to get pretty deeply engaged with the companies. We've been fortunate to have both extraordinary successes in just about every vertical that we're in. We're also fortunate to have had some companies that didn't work out, and it gives us, we like to say scar tissue forms stronger than skin. And I noticed that Dr. Wang mentioned sort of the importance of failure is not fatal. So we've seen both. We've been fortunate to have had companies that transformed the solar industry, like GT Solar, that transformed the cost of semiconductors and made the modern probably PV era wouldn't have happened if silicon didn't become economic and inexpensive and prices become reasonable. And in virtually every other vertical, from software for batteries to environmental services to the wind supply chain to recycling, smart buildings, industrial energy efficiency. We sort of look broadly across the whole sector. Our investor base is a combination of financial investors and also some strategics that are very focused in each of the verticals, some of the largest and smartest players that have global reach in each of the verticals that we invest in, across clean energy and climate, renewables and storage, and smart transportation, et cetera. We also like to look at the intersections between other parts of the economy where there are emissions and resource constraints, where businesses can really solve problems. So upstream, kind of minerals and metals and some of the things that are constraints. the intersection between water and resource efficiency and energy, the things that happen in the agricultural space, the fuel space. So that's kind of where Angeleno Group is. Looking forward to the conversation and meeting some of you over the next day or two.
Well, thanks for those introductions, and congrats to all of you for some extraordinary success. I think what I'd like to do now is get a little bit more specific, and if you could just lay out an example of a problem that your firm helped solve, and what was the underpinning insights that you had that led to a commercial opportunity. It's a little bit building on what you were just started, but go into a specific example. Could you start us off, Yaniv?
Yeah, let me try to give a couple examples. I mean, obviously, all of us are in the business of solving massive problems that have big businesses and rewards that go with them. Let me give you an example of something that's more recent and something that's a bit older, and different cases there. So one of our recent investments is in a company called Span, which some of you may have heard of, which is really redefining electrification in the home. They're basically introducing technologies into a portion of the home, the circuit panel, that has basically been analog and not very sophisticated, not controllable, not cloud connected for many years. So as we've introduced more electrification in the home, distributed energy, solar, electric vehicles, and we've tried to introduce some smarts at the appliance level, nothing has been done sort of upstream. So there's an example of a company that has attacked an area that hasn't had a lot of innovation because digitization, smarts and sensors, cloud connectivity, mobile devices have become really inexpensive. So that problem couldn't have been solved as easily 10 years ago, but it could in the last few years. And they really open up sort of home energy management, intelligence, maybe even AI applications to look at how we consume electricity in the home in ways that just weren't possible before. They're going at an area that has some large incumbents, where the technology really hasn't kept pace. Really, there hasn't been a lot of innovation. So that's an example of where the cost of componentry allowed a solution to come about that wasn't practical before in the electrification of the home. Another end of the spectrum, just a quick example, is one of our earlier investments in a company that was a semiconductor equipment player called GT Solar that basically took engineers and scientists from the semiconductor space that understood silicon, understood the industrial processes behind it, and it was at a time in which it wasn't so clear early on what chemistry was going to sort of win the photovoltaic chemistry battles. You might remember years ago, there was CadTel, there was silicon, there was SIGs, there was a bunch of others. It was confusing to customers, costs weren't clear. So this is a company that many years ago, we took it public on NASDAQ. It was the right time, right moment. It brought the geographic scale of global manufacturing, particularly Asia and China, into play. They manufactured equipment that allowed us to purify silicon and make cells and wafers in 2 orders of magnitude lower cost, basically collapsed the price of silicon and ushered in the possibility of the modern solar era through equipment, reactors, furnaces with known industrial processes, but applied for silicon for photovoltaics, and really just kind of opened up that entire market. So in that case, it was an equipment play using the commercial might that already existed in the industry, and went to some early customers that were new to the industry, so they were risk takers. They were willing to buy equipment that was new and untested in order to leapfrog other parts of the world, and really fundamentally change the economics and opened up probably one of the most important areas of renewables. So different risks taken, different approaches or business models taken, but sort of 2 examples of problems that I think were successfully solved in successful businesses. But both eventually went public, one more recently, one some years ago.
Well, it sounds like these firms combine several insights across the chain, not just technology, but market, timing. That's what made it successful.
Right, and engineers that were willing to lateral and transition from an area that they knew well to an area they knew less well. So here we are, for example, in Texas, some of the most important engineers and insights and process know-how exists in the oil and gas industry. To the extent that those brilliant field engineers and inventors lateral over into clean energy, those skills are incredibly valuable when reapplied.
Yeah, do you want to go through an example?
Sure. Okay, so I think I'll give one example of a company that is a former ARPA-E awardee, I will note. Actually, again, recent ARPA-E awardee, but also that I think gets across three things that I tend to like when I'm looking at companies. So I'll talk about the things that, the broader concepts here, and then talk about the company. The first concept is there's this trope in venture capital, which is sell painkillers, not vitamins, right? Things get adopted more if you're solving somebody's problem, not if you're giving them something neat. The thing that's challenging, I think, in the space that we inhabit, and certainly the space that everybody in the ARPA-E universe inhabits, is that actually what you want to be doing is selling painkillers 3 to 5 years from now, right? Depending on what you're doing. You're not in a position yet to solve today's pain. So what you have to do is kind of see around the corner and define what you think, have a really clear vision as to what you think the pain will be that you will solve in the future. So first thing is you gotta solve somebody's future problem. The second thing I really like is the logical chain of, if you believe this, then this other thing is inevitable, and that other thing is what we are doing. So classic example of this, which is not the example I'll talk about, but if you believe that electric vehicles are going to, over time, swamp ICE vehicles, then we are going to need a lot more lithium and nickel and cobalt and whatever else, and so that's your justification for investing in that part of the mineral supply chain and so on, and you can draw that logic down further. But I like the framing of, you have to believe something fundamental, but if you believe that, this other thing is inevitable. And the third thing is companies that plausibly have the possibility where an external event, something in the macro world, can happen and it can catalyze enormous growth and enormous demand. Now, you can't guarantee that a priori, but where you open yourself up to that possibility, it becomes an enormous opportunity for you. So those three things, I think, are all relevant for Form Energy, which is long-time ARPA-E awardee a while ago, and then just got another ARPA-E award. There's a couple people from Form here. Joe Manzer's in the audience somewhere, but it's an investment we share with BEV. The reason I bring them up here is, if you were looking, so Form was founded in, I think, 2017, right? So if you're 7 years ago now and you're looking at the trajectory in electricity, you recognize at that point renewables are getting cheaper and cheaper, and it's starting to become clear what is true today, which is if you're just looking for the cheapest kilowatt hours anywhere, basically in the world, the cheapest kilowatt hours you're going to get are going to be solar or wind, basically. Of course, the problem with that is the intermittency, and so you have to deal with that balancing, especially as you get more and more of it on the grid. We obviously had lithium-ion batteries already, and it was clear that for diurnal, for daily applications, lithium-ion batteries were going to be very well suited. But you could see into the future at that point and recognize that as we had grids that were increasingly dominated by intermittent generation, that weather was going to become a really dominant factor. And weather does not just exist in daily patterns, it exists in multi-day patterns. So you commonly will have these multi-day weather events that become challenging for you if you're a grid operator, right? So you could see around the corner and say, this is a pain point that our customers, which is utilities in this context, are going to be facing starting pretty soon, but then getting bigger and bigger into the future. It's also a sort of, if you believe this, then that story, right? If you believe renewables, sort of like electric vehicles, as I said before, are slowly going to be taking over the generation mix, both in the United States and globally, then inevitably you are going to need something that provides firm capacity. And there's only so many options for that. You have other options that are geographically limited, like geothermal. You have other options that are challenged by permitting and regulatory, like nuclear. But what if you could create a battery that actually provides capacity? So it's a similar sort of logical chain. And then the final bit of it is, we couldn't have predicted this back then, certainly nobody did, but now we are in the era of not unprecedented, but certainly unprecedented in the last 20 or 30 years, electricity load growth that is wreaking all sorts of havoc in the system. We are having a hard time getting enough generation connected, enough transmission built, and connecting all this new load that's showing up on the grid from a combination of electrification and manufacturing, and then most immediately data centers. That creates a need for anything that can help alleviate congestion on the grid, that can provide behind-the-meter capacity, that can basically provide value to the overall system. So Form, among many others, is going to be able to take advantage of that in the moment. So those are all things that Form is not unique in that, but we're often looking for things that you can sort of, at the front end, when it's just a glimmer of an idea or an experiment in a lab, you want something that you can have a really crystal clear story of, like, this is what you have to believe. And if you believe this, then this becomes an enormous opportunity.
Just a follow-on question on that, because it forms a good example. When you start with something that's way down the road, there's going to be a very long journey, and capital markets aren't always there for you along the way. But as you think about it right up front as an investor, how do you decide to go for it in light of the possibility of all these bumps down the road?
There will always inevitably be bumps along the road. I would say two things. One is it needs to be a long-term opportunity. If you're doing something that only is going to make sense for the next 5 years, nobody's going to get excited about it. So you have to be able to paint a picture of, this is a multi-decade, industry-changing opportunity. However, it can't only come to fruition in 15 years either, right? So you have to be able to find, okay, this is the acute situation wherein we can get into the market early. It's a customer who has a particularly large pain point. Maybe they have higher willingness to pay, whatever it might be. So you can draw a clear path from 0 to infinity, where you end up in 15 years. That's very important. And the other thing I would say is, and I know we'll probably talk more about that path to scale along the way, but very clear milestones and very clear cash management to those milestones is fundamental in these businesses, because you're going to need a lot of money in order to get the next phase of money that you're going to need. You need to be confident that this phase of money is going to deliver you enough of an inflection point to justify the next one. And the next one's probably going to be bigger than this one was. So there's a sort of milestone-based thinking that I think is important to imbue in these companies, even very early on.
I would like to add, we know these companies will take a lot of time and a lot of money, right, to reach maturity. So how do you de-risk them along the way? What are the pilots or the technology milestones that you're putting very early on to figure out that there is a real de-risking factor in these companies? What is the key megatrend that you believe in, that if that's going to be true, then there's going to be value at the end? So for example, for us, we always start with the technology thesis. We always start with, what's the landscape look like? So if you're going to have ultra cheap renewable electricity with high curtailment, how can that change the market? If you're going to have ultra cheap geologic hydrogen of $1 a kilogram, how is that going to change the use cases down the road? And we know those use cases may be 5-7 years down the road, but we're following that trend to kind of see ahead of the curve, as Shayle was saying. And the one example that I wanted to bring up that we've spent a significant amount of time on is decarbonization of heat. 3 years ago, it was not widely talked about, but we were looking at this trend of ultra cheap electricity, very high curtailment, to areas within the US where if you're using electricity to produce high thermal energy, you're competing with natural gas prices, right? And that's an opportunity that had come up. So we've made a number of investments in that space, and one of our companies that's on ARPA-E is ARPA-E Energy, that has managed to do a pilot, a successful pilot last year, demonstrate to a customer, and now talking to commercial contracts in the order of 3 years. They had to pivot to the right product in order to get to the market that fast, and that was slightly different than what we envisioned 3 years ago. But it's being able to pivot and have a large thread that you're following for where the value will be in that market.
Maybe we could shift a bit and talk about one topic that you all alluded to, which is the challenge of scaling up. And maybe we could start with just go back to the pilot area, and Christina, you started doing that. What does it take, from your point of view, for a successful pilot, and how should entrepreneurs think about getting their business set up for a successful pilot?
Sure, I'll go first.
Let's start.
Well, it sort of depends, right? Like, depending on what you are doing, I think, your pilot could be a relatively small thing. If it's in a shipping container, it costs you a couple $1,000,000 to build, and that's expensive because it's your first of a kind and you're not ordering anything at scale and so on. And that, if that's true for you, and that's a meaningful pilot, I mean, as Christina said, like being very clear about what actually delivers true technology de-risking, both in your own eyes and in the eyes of outsiders, is important. But if that actually delivers it for you, that's a fairly straightforward story. Basically, in all likelihood, you're just going to raise enough corporate equity from people like us that you can do your pilot on your own. There's the other end of the spectrum, of course. If you're making steel, for example, and you want to deliver a meaningfully scaled pilot that the steel industry is gonna trust, that's going to be orders of magnitude more money probably than my shipping container example. And so that creates a whole other challenge, and you need to make sure that you've got a market and probably offtake and figure out some clever financing strategies. So it's clearly, as with the pilots, with first of a kind, any of that stuff, there's no one size fits all strategy. I think everybody knows, but I do think it's important to start off early and say, okay, well, what would be the pixel size and the capital intensity of the thing we are going to need to deliver in order to prove undeniably to everybody in our sector that this thing works. How much money is that going to take? And then from there, there's a chain that tells you exactly what you're going to need to have in place and how you need to get there.
What's your experience working with corporate partners?
Well, what I was going to add to sort of this, how you think about pilots from a business standpoint, I would just say, really what you're trying to do there is two things. One is you're trying to demonstrate demand, real, genuine, deep demand from customers. So I would always set sort of pilot milestones in ways that puts you in a beachhead market with products, whether it's fuels, products, software, whatever, in people's hands, tested in a real industrial setting. And I think that that's often a challenge when you're starting with core technology engineering skills in a small team. One of my pieces of advice on scaling is never allow yourself to get disconnected from the commercial applications of what you're doing. Always connect yourself to that market, to that demand. And so when you're thinking about your pilot and what's in it and how big is it and how much money am I going to use of my finite resources for my grant or for my seed round or whatever, always connect yourself to sort of the commercial applications and to the customers. I also think that when you talk about sort of corporate partnerships, I think people sometimes can get drawn into the kind of the alphabet soup of series seed A, B, C, D, and consuming capital. And you gotta stop and ask yourself, who are my customers? And don't be afraid to do commercial partnerships with them. Don't be afraid to do that. There's capital out there. There's today, in 2019, 20, and 21, there was $1 trillion more of value traded on the stock exchange of publicly traded climate solutions companies. So your set of potential partnerships in the last 5 years have gone from a few hundred to a few thousand, probably an order of magnitude more. So I would be unafraid to forge commercial partnerships with people in industry that might have manufacturing, might have some input supply chain help for you, might have some insights about customers, and embed that into sort of the thinking. You guys probably.
The other thing we've seen with pilots, one of the success metrics is the companies that treat their pilot as if it is their first commercial project. Like, even though they're using Topco equity, even though that's a unit that's demonstrating some key technology milestones, if they're using it to build the muscle that they will need to prove credibility and to do the first of a kind plant, right? They're using it to understand vendors, understand their cost overruns, understand relationships with the PCs, bring customers so that they understand the specifications that that customer is going to need. The companies that try and build that muscle of organizational excellence and expertise early have really benefited. Because you're always going to need to scale up from the pilot to the commercial, and you're always going to need to show that credibility while still being a startup with limited resources. And a way that you can do it is by treating the pilot as if it's a commercial project.
I'd say one other thing, which is related to the sort of commercial partnerships thing, which I agree with, and I do think you want to use the pilot to demonstrate demand. But the one cautionary note that I would offer is that oftentimes if you're trying to do a pilot in partnership with some large commercial entity, you have misaligned incentives, right? For you, the pilot is existential. You need to build it as fast as you possibly can. You need to prove it out. this is the next step in your evolution as a company, and it's all that matters to you, basically. For the partner, oftentimes, especially because it is a pilot, and so it's not actually, even if you're offering a painkiller, this is not going to solve their pain because it's a pilot. It's too small, generally. So for them, it's a showcase. It's interesting. Like, it's going to be in some innovation group or something like that, oftentimes. And that creates this misalignment of incentives, particularly around timing, that can become sort of dangerous for you, because if you're reliant on some partner and they're moving slower than you want, or they have some corporate reshuffle or whatever it might be, that's tough. So generally, the advice that we try to give is absolutely forge partnerships of whatever sort you can, but to the extent that you can, control your own destiny. If that means you have to build it on spec yourself, that's okay, generally speaking, because existential for you is building it, operating it, improving it. And you want to make sure that you don't lose control of that by handing it over to some corporate partner too early.
Yeah, and if just add something quickly to sort of control your own destiny, I think as entrepreneurs, engineers, scientists, all combined into one, I think part of your job is to develop, we like to call it multiple shots on goal. You have to develop optionality. You've heard every person on this panel use the word pivoting, developing muscles that you'll use again. So I think that having multiple, not too many, but multiple markets that you could see your technology applied in gives you the ability to control maybe your own destiny and sort of have some optionality. Just develop a series of valuable options for yourself.
Yeah, our time is coming to an end, and that's kind of leading into a good wrap-up. It'd be very helpful to the audience, I think, just to hear what you have to say to early-stage companies in the audience, academic innovators in the audience. What advice would you have in today's world as they're thinking about how to make a difference? Who wants to start?
Yeah, I think I'll start with the early-stage innovators, the students in the room, the researchers in the room that are now thinking of starting the company or at the very beginning stages. I would say focus on building your advisory board. At the very, very early kind of fundamental, like first months, first couple of years, find the best people in the world that you think are experts in the technology that you're addressing and get them close to your company. Because you're still at the seed stage, potentially pre-seed for many of you. How do you build that credibility is by recruiting those experts that are going to look at what you're building and put their stamp of approval and also their advice and their guidance from all the learnings that they have done. So putting that in place early and building those relationships. And the other one would be for the early CEOs in the room to look at yourself as a recruiter. Whether you're recruiting investors because you need capital, whether you're recruiting customers because you're trying to build sales, whether you're recruiting people to join your firm and put their most valuable resource, their time, to work with you. At the end of the day, like a CEO is a recruiter. So that's how I would view the role and I would approach those early years and early months of formation, I would say.
I agree with that. And I guess the other thing I would say, particularly for early stage companies or proto-founders who are technical by nature and have a technical innovation, be super deliberate about, own your domain, understand the market that you're going after inside and out. Oftentimes what we'll see is sort of technology-focused founders, they understand the technology they're going after extraordinarily well and all the nuances of it, but they don't have the equivalent understanding of the market context in which they're operating and the players and the value chain and all of that. It's equally important for you to understand, and so you want to avoid myopia on the technology. And so as early on as you can, I would say try to dedicate an equal amount of your own effort to your technology development and your understanding of the market context in which you're going to be operating, because the combination of those two things is what makes a business. And so think about that just as deliberately as you think about moving up the TRL scale or down. I never know which way the TRL scale goes.
Yeah, all of those are great, leaving me with fewer choices to share with you. But
You'll come at a bit later as well. So when you look at a business that's further down the pipeline, what's the things that you're looking for?
Yeah, well, I mean, if I think about the companies that have successfully scaled and graduated from sort of the earlier stage to the growth stage, some of the things that I notice is you have to be comfortable with constant change in your product, in your technology, in your team. You have to test constantly, iterate quickly, fail quickly, test again. So I noticed teams that have a certain level of speed and resilience that's unique. There's usually changes that also happen along the way from the team itself, like the skills that you need in the very early stages, early demonstration. Some of them evolve over time. So look at the people that are around you on your team. Make sure that your skills, your magic powers are orthogonal to one another. Not a bunch of people that came out of the same lab doing the same technology in the same way. So get orthogonal thinkers and people whose skill set is sometimes radically different than your own. That could be uncomfortable, but I think that's a measure of something that when we see growth companies, they'll tend to have some of that. Sometimes you just, you hit the right market at the right time, there's a little bit of luck, right? But to expose yourself to that luck and fortune, there's also no substitute to intensity and hard work. You put the time in, there's no shortcuts, and it'll be visible. So I'd focus on team, resilience, and comfort with change over time.
Well, I have to make a pitch for Texas as I listen to what you all say are the skills required to be successful across the stage of investment. We have it all in Texas. So you all spend a lot of time on the coast and have a lot of insights there. But as you scale up, we're the place to go. Get your portfolio companies here. Get your capital here. I'm glad you're here. It should stop you from leaving until you meet everybody. I think we're out of time. I just want to thank our panelists for a fantastic discussion. I knew I'd learn a lot, and I did. So Christina, Shayle, Yaniv, I appreciate you being here very much. Thank you much.
Thank you.